Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. You know, how to navigate the ever-changing bond landscape, the barbell. Let's talk about that. The first 3 months and change of 2024 has brought with it a rather noteworthy shift in bond market sentiment. With Fed policy decision-making remaining data-dependent for the foreseeable future, investors have been left to wonder how to position their fixed income portfolios for these changing interest rate landscapes. In my opinion, investors can utilize the time-tested barbell strategy to navigate not only the current setting, but more importantly, what potentially lies ahead. Now, let me provide a quick perspective on how rates and rate expectations have changed recently. One only needs to see the movement in Treasury yields over the last 6 months to highlight how the rate backdrop has shifted dramatically. And so after essentially hitting the 5% threshold, if not higher, the U.S. 2-year and 10-year yields fell by more than 100 basis points during the Q4 rally before reversing course and retracing about 50% of that decline as I'm speaking to you. Now, it hasn't been a complete round trip, but the story isn't over yet. And, you know, a repeat performance of this type of rate movement is not expected anytime soon. But this episode does underscore the importance of utilizing a strategy that can help navigate the uncertainties that still exist in the money and bond markets. Now, what do I mean by uncertainties? Well, let's begin and end with upcoming Fed policy decisions, just to keep it simple. If, in fact, that's going to keep it simple, right? Coming into the year, the expectation was for 6 rate cuts, with the initial move being for March. And as I'm talking to you today, the implied probability for Fed funds futures has now slipped below the Fed's dot plot projection for 3 moves. In fact, there's been increasing talk that if the labor market and inflation data continue to come in as we've seen up to this point, perhaps there'll be no rate cuts in 2024. For what it's worth, I'm in the 3 or less camp at this stage of the game anyway. So how can investors prepare their bond portfolio for this looming uncertainty, which, by the way, will more than likely carry into 2025? That brings me back to the intro, the barbell strategy. And the one I'm going to discuss allows investors the flexibility to begin adding duration in a deliberate fashion while still taking advantage of the income available in the ultra-short portion of the inverted yield curve. Now, the adding duration aspect is designed to not only begin locking in yield outside of shorter dated maturities, but, it also offers the ability to take part in a bond market rally if rates were to reverse course and fall again. For illustrative purposes, the Wisdom Tree in-house barbell utilizes our floating rate Treasury fund, USFR, for the ultra short position, and our yield-enhanced U.S. aggregate bond fund, AGGY, for the duration counterweight. So to sum it up, this hypothetical barbell potentially offers a yield advantage of almost 50 basis points versus the benchmark AG, but with only 1/3 of the duration risk. So let's sum it up. What's the bottom line? With uncertainty surrounding Fed policy and bond yields, the barbell approach provides investors with a time-tested, flexible strategy to navigate the road ahead without making an outright rate call. So I'm going to end it there. I hope everybody has a great rest of the week and be well. And before investing, carefully consider a fund's investment objectives, risk charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.
Past performance is not indicative of future results. Securities with floating rates can be less sensitive to interest rate changes than securities with fixed interest rates, but may decline in value. Fixed income securities will normally decline in value as interest rates rise. The value of the investment within the fund may change quickly and without warning in response to issuer counterparty defaults and changes in the credit ratings of the fund's portfolio investments.